Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. There's about 30 minutes to go until the closing bell, and stocks lower here as investors digest President Trump's latest commentary on the Fed. We'll get to that momentarily, but first, our very own Jared Blickery is standing by with the latest market moves. Jared.
Thank you, Josh. Yeah, a little bit of negativity here. Let's check out the Wi-Fi Interactive, where we have the major indices for the most part in the red. And I'll start with the Dow here. That's down about 1% or 481 points, almost 500. You can see we are at the lows of the day there. So we'll have to see. We got 1 hour or half an hour left to see if we can change those fortunes. Here's the NASDAQ composite. We were green early. We were red. We are back in the red here, challenging those lows from the earlier part of the day. And then the S&P 500 looks like it is at the lows of the day, hitting those fresh lows just over the last few minutes, down about 0.5%. But it's not all red here. We got to check out the small caps. Russell 2000, that is up about 11 basis points. It's not a lot, but Russell 2000 coming off of a record high, which means if it's settled at this level right here, that would be another record high. And here we have the S&P 400. Don't talk about that a lot, but this is a mid-cap sector. And mid-caps are coming off another record high for them. And guess what? This would be another one if we hold on to these gains here. It's only looking at about 4 basis points, so that could easily swing into the red. And let's check out the sector action. Kind of a defensive setup here. We got energy up 1.5%. After that, staples, real estate, utilities, industrials, materials, all of those outperforming the S&P 500. But to the downside, check out financials. JP Morgan earnings, not the greatest in terms of investor minds, and so that is down 2%. Communication services also off about 0.8%. Here's a look at the NASDAQ. Alphabet at a record high in the lower left there. That's up 1%. Broadcom up about 0.2%. Walmart in the upper right, almost up 2%. We are seeing some winners here. It's not all losers, but for the most part, the semiconductors looking pretty red. Some of the exceptions, AMD and Intel, each of those up about 1% or 7%. And let's take a look at software as well. A lot of red here. IBM down 3%. Salesforce down over twice that. Adobe down about 0.5%. But I do want to get to the banks because those are what we are seeing in earnings this week. There's JP Morgan down about 4%. A couple of green spots over here in some of the smaller names, but for the most part, Wells Fargo, Morgan Stanley, Goldman Sachs, Bank of America, all those down about 1 or 2%. Josh.
All right, Jared, thank you. Appreciate it. Well, President Trump using his trip to Detroit to slam Fed Chair Jerome Powell and the central bank yet again. Yahoo Finance's Jennifer Schonberger joining us here with the very latest. Jen.
Good afternoon, Josh. On his way to Detroit to give a speech on the economy, President Trump once again laying into Fed Chair Jay Powell.
Well, he's billions of dollars over budget, so he either is incompetent or he's crooked. I don't know what he is, but he doesn't do a very good job.
Later during a tour of one of Ford's factories, Trump called Powell, quote, bad in a lot of different ways, but he's bad because his interest rates are too high. Trump called today's inflation report on the CPI, quote, great, and says we have a great, strong economy. He also talked about renovations of the Fed's headquarters here in Washington, calling it the most expensive construction job in history, and that's just a renovation. Trump called Powell, quote, saying, Trump said either Powell said, quote, doesn't know what he's doing or he's worse than that, so hopefully he'll be out of there soon. Now, during his speech in Detroit, Trump said that he wants a Fed chair who will lower rates to allow the stock market to rally.
You announce unbelievable numbers and the market goes down because they know you're going to do everything possible. In the Fed, we have a real stiff in the Fed. We're not doing it anymore. We're talking about the head of the Fed, and I want somebody that when the market is doing great, interest rates can go down because our country becomes stronger. See, you view it differently. Our country becomes stronger, and therefore interest rates should go down, not up.
Elsewhere, St. Louis Fed President Alberto Musalem weighed in on the investigation into Fed Chair Powell, saying that Powell's video message Sunday night was very direct and clear. He stressed the importance of central bank independence and saying that making sure that politics does not get in the way of monetary policy allows more stable prices and maximum employment. Josh?
All right, great stuff as always. Thank you, Jen. Stocks falling despite the milder than expected December inflation print as investors grapple with potential threats to the Fed's independence, flurry of policy proposals out of the White House, and earnings. Joining me now on this, we got Brett Ryan, Deutsche Bank senior U.S. economist, and Darius Dale, the founder and CEO of 42 Macro. Guys, welcome both of you. Brett, as the resident economist on the show, I'll start with you. The CPI print, I'm curious what you made of it, and what do you think the Fed made of it, Brett?
Yeah, I mean, I think the details were a little bit worse than the headline suggested. So you had a few categories that were outliers. For example, wireless services had a massive minus 2.7% print. You know, that's the largest downward movement in several years. You also had some stuff on tech goods side that was extreme weakness. So, for example, trim mean and median CPI were higher both than the headline print. So I think some of it gets dismissed. In fact, rents were a bit stronger than we and most had anticipated, particularly owner's equivalent rent. And it really doesn't change all that much, I think, for the inflation outlook. We still expect rents to have further payback come April. And the inflation market, we haven't really adjusted our forecast on these numbers at all. So yeah, on the surface it looked good, but there were a few categories that really weighed on the core print.
How many cuts this year, Brett? What's your base case?
We have one cut.
One cut.
When we only have one cut in September, we have a base case of strong growth this year and a labor market that's improving. And I think the other point here is that inflation's less of the factor right now in the Fed's calculus and in terms of cuts. It's more about the labor market. When you listen to people like Alberto Musalem, if risks to the labor market increase, then they're willing to cut. But for now, they see with their growth forecast, they see things on hold. They see things on hold for the near term.
Darius, you've been listening patiently. What do you think? You generally agree, Darius, with what Brett's saying there?
Yeah, generally speaking, although I will push back and say the only thing I really strongly disagree with is that the labor market is going to recover. We very much see the economy booming this year and have continued to see this structural increase that we are falling for in productivity growth as contributing to the ongoing disinflation alongside cooling wages and housing prices. If we look at today's data, we don't tend to analyze things on a month-over-month basis. It's too noisy. But when you step out and look at the 3-month annualized rates relative to the 6-month annualized rates relative to the year-over-year rates, we got weak negative impulses in core CPI, core goods CPI, core services CPI, and a strong negative impulse in shelter CPI. So that all supports our expectation for continued disinflation and downside surprises in inflation, which obviously productivity is a contributing factor to.
Brett, I want to get your take on this other story. Jen Schonberger was talking out there, this criminal investigation into Fed Chair Jay Powell. You heard President Trump going after him again there today. What do you make of that? Are you concerned about Fed independence, Brett, when you hear that?
It does obviously raise concerns. I think the fact that you've had influential members in the Senate Banking Committee, Tom Tillis, Senator Kramer, who have indicated that they will not move forward a nomination for the Fed chair until this resolved was important in terms of limiting the market fallout thus far. If there was less pushback, I think, from Congress on the attacks and less protection from Congress, then I think it'd be more serious. But at this point, it seems it's more of the same pressure campaign. If anything, it's counterproductive, and it's more likely that Fed Chair Powell stays on to fill out his governor role and denying Trump another board seat, if in fact he sees further threats to Fed independence.
Darius, how about you? Are your clients asking you about this, Darius? And if so, what are you telling them?
Yeah, great question, Josh. And so I completely agree with Brett in this view that the Fed chair himself and the other members of the institution may dig in and present a united front against President Trump. And so this may actually delay any incremental monetary easing and cause some issues, obviously, in broader financial markets. But to me, I think this discussion between President Trump and Jay Powell misses the broader point of why this is all happening. The most important dynamic that is occurring in global financial markets, according to our research, is that there is a growing geopolitically driven supply and demand imbalance in the Treasury bond market. And much like we saw in the previous foreturning in the 1940s and 1950s, it's highly likely that the Fed's independence will get eroded over time anyway. So you can replace the characters with new names over time. But the reality is the Fed is the only institution in the world that has a balance sheet large and flexible enough to fill the void. You think about the amount of capitalization that occurs in the Treasury market every year, it's up to about 11 or $12 trillion per annum, which is about 40% of global savings, up from a long run mean of about 20%. Now, investors like us, the private non-bank sector, we own almost 60% of the marketable Treasury debt market, up from only 36% in 2021. This market is changing dramatically, and it's the biggest, most important market in the world, and the Fed's going to have to fix it in greater and greater quantities over the long term.
Darius, I also want your take while I got you on the stock market. I do hear this theme, Darius, strategists coming on the show and sounding generally bullish, constructive, but also expecting, Darius, greater volatility this year. Is that what you expect?
Yeah, we've been on record on this program and several programs that there's a historic degree of crowded bullish positioning in financial markets right now. And so it doesn't take much for a correction to occur. At the bare minimum, some continuation of chop, and the chop may become even more violent to the extent that the geopolitical dynamic or the Fed independence dynamic gets exacerbated in financial markets. But underneath it all, we have a cyclical upturn in productivity growth that our research suggests is likely to transform into a structural upturn in productivity growth. We see the U.S. economy transitioning itself from a 2% per annum trend productivity economy to a 3% trend productivity economy, and that process is already ongoing. And so you have to take you have to apply a bullish lens with respect to medium to longer term market risk in the context of that dynamic alone. We could be wrong on that, but investors could be wrong on anything they think at any given time. So the reality is you got to put on positions to make money in financial markets. And we've been doing that at a very high level for our clients.
Brett, I'll end here with you. I'm curious to get your take on what we're seeing with precious metals. Just gold and silver hitting records again today, Brett. Just as an economist, what do you make of that? What do you think message that's sending me as an investor?
Sure. I mean, it's really quite simple. Central banks, especially China, Russia, Turkey, others that have seen the fallout from the Ukraine-Russia situation and seen the Russian central bank reserves being frozen by the ECB, they're buying. They're buying a lot of gold, and they've been structural buyers. And the simple, mantra is in markets, whatever the central banks are buying, you buy. So I think that's a reflection of that, and maybe some of the reflection of what Darius is talking about in terms of eventual Fed monetization of the debt, which brings on a whole new set of issues. But to Darius's point of productivity, it's a very interesting, it's a very good one, because one of the corollaries of that, though, is a higher R star and a higher neutral rate of interest. So the Fed may not be cutting much further if you have a productivity miracle, because you have a higher neutral rate. So it certainly would be a help on an inflation front. There's also questions around the labor supply front. Brookings had a piece out recently talking about potential negative labor supply in 2026. So that means the break-even pace of employment growth is potentially minus 10,000 or 20,000 on payrolls per month. Right now, it's probably 25 to 50,000. It doesn't take a lot to move the dial because of the immigration crackdown.
Brett, Darius, thank you guys. Great to have both of you on the show today. Appreciate it. Straight ahead, Microsoft making moves to get ahead of the political blowback on its data centers. We're going to look at what it means for investors. That's coming up next. Microsoft is laying out its AI infrastructure plan with community in mind. Yahoo Finance's Dan Howley joins us now with a closer look. Dan.
Yeah, Josh, this is basically a community-driven effort or a community-focused AI effort that Microsoft President Brad Smith laid out in Washington, D.C. this morning, basically pointing to a few of the major flashpoints that have kind of set off these protests against data centers in some parts of the country. And so they wanted to kind of lay out this plan where they can deal with some of those. That includes Microsoft saying it would bear the burden of potential upgrades that infrastructure companies like electric companies need to make to transmission lines, if that's necessary when they build data centers. They also talked about ensuring that when a data center goes up in a community, it won't impact electricity prices so that the local community doesn't have to feel that pain. They also went on to discuss things like water usage, which is a major problem for data centers to keep their thousands of chips cool. Microsoft says that they'll end up replenishing more water than they actually use for these kinds of projects. And they also talked about taxes as well as jobs. He's saying that they wouldn't work to get a lower tax rate in certain areas when they build data centers, and that they would put money into some of the infrastructure in communities, and then train up some of the workers to actually work within those facilities as well. And as I said, this is all part of a kind of playbook to avoid this backlash from data centers that we've seen, where, there's been these protests, there's been concerns about what this means for well water in certain areas. We've seen electricity prices increase. Now, that's not just because of data centers, it's because of long delayed infrastructure upgrades that power companies are making, inflation, any number of factors. But, if data centers are a part of that, then you would naturally expect people to say, well, how come I have to pay for that now?
Dan, thank you, buddy. Appreciate it. For a look now at what is at stake in the expensive and complex build-out of AI infrastructure, let's get to Intelligent Alpha founder and CEO. That would be Doug Clinton. Doug, it is great to see you as always. Let's start, Doug, on this Microsoft news that Dan Howley was just highlighting there for us. I'm curious what you make of that, Doug. There has been this political pushback on data centers. There was this journal had a piece not long ago on this, Doug. I don't know if you saw this. And the headline here, the political left is dialing up scrutiny of data centers. They talked about how Bernie Sanders is very focused on high power prices. Is that what this is about, Doug? Is this Microsoft saying, okay, there's this issue bubbling up here, we gotta find a way to address it?
I think it is, Josh, and I think that the data center build out will not stop, nor will the political pressure stop. I think we're going to continue to see over the next several years these tensions come to a head, and I think there will be these types of agreements where these hyperscalers, whether they be Microsoft, Amazon, Google, they come into communities, and obviously they've been building data centers, Amazon in particular, for a very long time with AWS. They've been building these data centers, and I think they know how to deal with communities when they come in. I do think the scrutiny will continue to increase, but I think the AI train is just so hard to stop right now. I don't know that there's a ton of political ability or even willingness really to stop America being the AI power ahead of other rivals around the world.
Well, let's stick with Microsoft, Doug, because their president, Brad Smith, made some news with the FT. I want to get your take on this as well. China is winning the AI race outside of the West. Saying we have to recognize that right now, unlike a year ago, China has an open source model and increasingly more than one that is competitive. They benefit, he goes on to say here, from government subsidies, he says, allows them to undercut American companies based on price. I'm just curious what you make of that commentary, Doug. Do you see this sort of Chinese AI momentum he's talking about?
I think everything that Brad Smith said is true. You really have two players. It's a tale of two players in the AI race. In America, we lead, I would say, AI in aggregate, really on the frontier. So closed source models, whether they be from OpenAI, from Google, from Anthropic, xAI, those are the four big players we have, and they all have incredible models. I would say that they are a little bit ahead to a lot ahead of the open source models, where China is very competent. And that's going to be, I think, a big part of the race over the next several years between the two countries. The other thing, besides just thinking about the two dynamics of closed source versus open source models and how they get funded, private industry in the US, government help in many cases with China, I think one of the big questions will be back to infrastructure where you started, Josh, because the other thing that China has that I think is kind of an advantage relative to the US is much more willingness to build infrastructure, and in particular, dirty infrastructure, right? I mean, they don't have the same level of concern around how's the power generated to get data centers online and powered. They just say, get it done, right? And they've also been building nuclear power plants for the last several years, where in the US, we haven't built one in several years. And so I think we need to catch up there on that front.
Let's stick with China, all things AI. This report from The Information today, Doug, I want your take on that too, how the Chinese government this week telling some tech companies it would only approve their purchases of Nvidia's H200 AI chips under special circumstances, such as for university research, for example. You saw that headline. What do you think?
Yeah, this is probably going to be something that continues to get negotiated for months on end here. I mean, I think we've been talking about Nvidia coming back to China now for the better part of the last 6 months. And now it's kind of the ball is in the court of China where, what will they allow companies to do? I think the bottom line, though, is this, Josh. At some point, Nvidia chips will return to China. That will be a tailwind for Nvidia because nothing's really priced into the stock right now, in my opinion, for China. I think investors have just totally written it off. And I think the question will be, how will these regulations be structured in a way that China looks good to their constituents, but also allows them to get access to the chips that they need to continue to build these open source models and compete with the US, as we were just talking about.
With Nvidia, Doug, what do you make of the price action there? I mean, I'm just looking, it's been basically in this kind of rough trading range here, going sideways for about 6 months. What is going on there?
I think there haven't been any meaningful new catalysts for the stock. The biggest event, I think, over the past few months for Nvidia was when Jensen went out. He talked about this $500 billion backlog, which suggests that numbers are, significantly probably better than where the street was at looking into 2026. That backlog is for both Blackwell and Rubin. And I know at CES, he did mention that that backlog continues to grow. So I think from a fundamental standpoint, everything looks on track for the stock. I think the problem, though, is so many investors are already fully allocated into Nvidia. It's hard to find that incremental buyer to really move the price. From a mega cap perspective, I would tell you this, though. At Intelligent Alpha, we use these large language models to do our stock portfolio management. And our models have really liked Amazon coming into this year. From the mega cap perspective, I think that's the one that we want to own right now.
Why, Doug?
Own it in our GPT ETF.
Run me through that. How come?
Yeah, I think that it's a little bit analogous to the Google story of mid last year, where it felt like Google was just totally washed out in the summer. All the bad news had been priced in. Search was going to die to AI. They released a new model. At that time, it was Gemini 2.5. The model was great. And then the story just turned, right? People started using Google products. They were more aggressive, putting the products into their existing user base, and the stock took off. I think Amazon's kind of similar. The stock was up about 5% last year. It was the worst performing mega cap, if I recall. And I think it's set up right now where there's no AI bid in the stock. AWS had a great quarter last quarter. If they can keep showing some acceleration on the AWS side, I think they can get an AI bid and the stock could work from here.
Doug, always great to see you. Always great to have you on the show. Thank you, sir.
Thanks, Josh.
Well, breaking news, shares of Warner Brothers Discovery spiking in late trading here. Bloomberg reporting that Netflix is looking at amending its bid for the legendary Hollywood studio and the company's streaming business. And the key here is Netflix could shift its offer to all cash. The report says the goal is to expedite the sale that is facing competition from, we know, Paramount Skydance, which has taken its offer hostile to buy WBD. Right now, shareholders are split on the offers. One of the main differences between the offers is that David Ellison's Paramount offer is for the entire company. Ellison is also offering $30 a share against Netflix's price of $27.50 a share. And it comes after Paramount Skydance just sued WBD seeking financial details of the $83 billion tie-up with Netflix. Well, we're wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action. Following the closing bell, stay tuned for Market Domination Overtime.